calling all entrepreneurs. Get ready because today we're going to show you the money. It's all about the dollar bills, y'all. Coming up next on The Pulse. Hello, I'm Denise Roberts and welcome to The Pulse, the show dedicated to helping Prince George's County businesses. When looking for investors, your pitch is the single thing that could either get your business off the ground or plunge your idea into eternal oblivion. It matters. The rule of thumb for investors is that for every 100 investments they make, only 10 will go big. Going a step further, for every 1,000 pitches an investor hears, he or she will fund only 100 of them. Statistically, the odds for success are not great, but you can beat the statistics by crafting a pitch that turns heads and gets funded. Joining me today is Lorette Farris, CEO of Lifecycle VC, Chief Investment Officer of the DA Group, and CEO and Business Strategist of iBusiness Incorporated. Lorette, welcome.
Thank you so much. I'm happy to be here.
So you do a lot by all those titles. Can you just tell us a little bit about what it is that you do?
Absolutely. I work with a venture capital firm that assists early stage and startup companies in raising capital, as well as we work with more mature businesses in figuring out what the other side of business ownership is. So Lifecycle VC is designed to work from the beginning through the end with businesses.
Okay, so let's talk about companies who need to raise capital. What does it actually mean to pitch your business to an investor?
Okay. What it means is basically a pitch is a presentation. You're doing a presentation to an individual or a group of investors in order to get their interest in possibly providing you with the capital resources you're seeking.
Why is there such a need to turn to venture capitalists today?
Most companies, especially early stage startup companies, especially companies that are designed for high growth, they are not going to fit a model that a bank would finance. Banks are not in the business of taking risk, but raising capital, what you're talking about doing is raising private equity. Private equity is the space that they're willing to take a risk, and it's that whole story of risk reward. They're willing to take that risk because they're looking for a nice reward at the end.
Okay, and so when you're talking about having investors invest in your company, what does that look like? Do you have to pay the money back, or are they there to stay?
Okay, so there is a big difference between what traditional financing, i.e. debt from a bank is or looks like, versus what private equity individual investors look like. Both are looking to be paid back.
Okay.
The difference with investors and what they're looking to be paid back, they're not looking to be a bank. They don't want to make a loan that you're paying back 10% interest. They want to make an investment that potentially in 3 to 5 years, they're making 3, 5, 10% return on the money that they put in. So is there a payback? Yes. It just happens differently than it does when you go traditional financing.
Given the many different types of alternative financing outside of the traditional banks, what are the different types, or what are the alternatives, and how do you know which ones to pitch your business to?
So first, any company has to figure out who they are, where they are in the stage of operation for what kind of capital makes sense for them. So if for the sake of this conversation, we're sticking with early stage startup companies, how do you know when you're at the place to pitch? When you feel you have something viable enough going on that you can help someone understand how they can make money by putting money into you. For instance, a company that is truly startup, they're at the concept or seed stage, they can raise equity investments just like a company that already has some traction going on. But it's going to be a different kind of investor, and there's going to be different expectations. If you only have a concept and you need, say, $25,000 in order to produce the prototype, well, that's a particular investor that might listen, and you have to know how to explain to them what you're looking for and again, how they'll get a return. So there's some understanding a company has to have for who's going to be interested in them.
Okay, so when making a pitch, what are some of the things a business owner needs to keep in mind?
Okay. You got to keep in mind that an investor is interested in understanding who you are, what makes you believe you're the right person to do this and have benefit of their money, and how you expect to help their money make money.
Okay.
So those are like 3 key top line things you need to be able to understand.
Okay. And what are some of the common mistakes that businesses are making in their pitches?
One of the first things I would tell you from some of the current events that we do is young companies.
Let's just hold that thought right there. We're going to come back to that. We're going to get more into this in our next segment. Today's Selfie on the Pulse is from Josie Thompson of Josie Designs, a Maryland-based and an independently owned graphic design firm focused on transforming clients' visions into cohesive graphic design solutions. For a chance to see your business on this show, take a picture of you and your business, but it has to be a selfie, and send it to us on Twitter at PGC Diversity. And don't forget to use the hashtag #SelfieOnThePulse. More with Lorette Farris when we return, but first, the Pocket-Sized Business Guide is next.
The average text takes your eyes off the road for nearly 5 seconds. Stop the texts. Stop the wrecks. Visit us at stoptextsstopwrecks.org.
Whether it's angels or venture capitalists, sometimes you only get 10 minutes or less to pitch your business opportunity to investors. So don't forget to rehearse your pitch over and over. Here are a few things to keep in mind when preparing your pitch, courtesy of bplans.com. First, begin your pitch with a compelling story. This will engage your audience right out of the gate. If you can relate your story to your audience, even better. Number 2, share what's unique about your product and how it will solve the issue you shared in the previous slide. Keep it short, concise, and easy for the investor to explain to others. Number 3, this is your opportunity to blow your own horn. Impress the investors with what you and your team have accomplished to date, like sales, contracts, key hires, and product launches. Fourth, be realistic about who you're building your product for, and don't say that everyone in the world is potentially your market. And finally, investors tend to care about your revenue model the most. How will you make money? Be very specific about your product and pricing, and emphasize again how your market is anxiously awaiting your arrival. Hopefully, these tips gave you some helpful ideas on how to wow investors so you can get funded. We'll be right back.
I've come up with a family emergency plan.
What is it?
It's difficult to talk about, so I'm not telling you.
I'm so glad I won't have to remember anything.
Me too.
Visit ready.gov/kids for tips and information.
Welcome back to The Pulse. If you're just tuning in, we are talking with Lorette Farris about raising capital for your business. And specifically, earlier we were talking about mistakes that business owners make in their pitches. What are some of those?
So I would probably tell you the biggest thing that they have to learn is how to value their business. Okay. Because as soon as they come out the gate and mention the valuation, which is always going to be a difference between the entrepreneur and the investor, but early stage startup tends to tremendously overvalue, because a lot of times they don't understand the pieces. So number one, I would tell you, knowing how to put an appropriate valuation will keep the conversation going.
Okay.
Traction, as you mentioned in the tips, is huge also. And that's because you have different investors. Some investors will invest in pre-revenue companies and some want post-revenue companies. Well, if you're pre-revenue, be able to talk about any tests that you've done, any surveys that you've done, who is interested, and how can you validate their level of interest.
And what about post?
Post-revenue, it's just a matter that you actually have a business. You don't have a business until you start selling something, right? So you also have investors that will look at the different ranges. Some investors aren't interested in investing until the company has reached $500,000 in revenue, but then you do have investors that will look at less. But at the end of the day, once you're post-revenue, you have a better shot at a wider range of investors being interested.
Do you find that companies actually, when making their pitches, actually know what it is to ask for from investors?
If they've done their homework, they will know. I don't know that there's any kind of training, books, or anything else that doesn't help you to understand that your ask is a big part of saying the right thing to an investor. But knowing what that is, that does wind up being a little more difficult.
So what are you supposed to ask for?
There is no one answer to that.
Okay.
Your industry, what you're doing, where you are, who's your team, how are you going to execute, and then who are the investors you're speaking with. You got to do some good research to make sure that you're reaching out to the investors that make sense for what it is that you're doing.
But generally what we're asking for is money.
Well,
so
I'm sorry.
About
so let me back up. Yes, it's money.
The amount of money. So,
yes.
So they need to know how much to ask for.
They need to not only know how much to ask for, but when I say valuing your business, it is your business at the stage that you can say to someone, this is $1 million, value the business at $1 million, and so I'm looking for 25,000. Or do you really think you have a business you could step in there and say it's an $8 million valuation, and I'm looking for $4 million. So how much you're asking for and what you're valuing the business at.
So what is it that venture capitalists want to hear that will make them say yes?
So the little adjustment I'm going to make is venture capitalists versus angel investors. Both are in the private equity space, but venture capital, very seldom, less often, are you going to get capital when you're in that early stage startup than with angels. Okay. And so those early stage startup companies, you sort of work through that trail of friends and family, money you bring in, and then you might be ready for angels, and then you might be ready for venture. So you sort of step up where you're going.
So what are the angel? So what are the angel investors? What's the primary difference between?
The difference is angel investors are generally investing their own money. Venture capital are investing other people's money. So they do bigger deals. The deals that they're going to look at, they're looking for you to be a more higher growth because of the bigger, dollars that they're operating with.
And how do you know when you're ready to go after the funding? In a quick answer.
That's I had to take a breath. You know you're ready when you have all the right pieces together that you can explain to someone how you can help their money make money in what period of time.
All right. Lorette, Farris, I want to thank you so much for coming on the show, to talking about this very important topic. And that's our show for today. Thank you for tuning in. This show and previous episodes are posted on our website, diversity.mypgc.us, and click on the pulse. We are on Twitter and Facebook at PGC Diversity, and our YouTube channel is The Pulse TV. Next time on The Pulse, Jim Coleman talks about what the Prince George's County Economic Development Corporation's been up to, and a young millionaire in the making. I'm Denise Roberts, and remember, in Prince George's County, your success is our success.